For the last 9.5 years, nothing has been able to stop the market. So could DC turmoil be a threat to the longest bull rally ever? Bob Pisani is at the New York Stock Exchange. Hi, Bob.
Hi, Melissa. You know, short term, Washington is not an immediate threat, at least short term here. So look what we've got right now. We have stable inflation. We've got a neutral Fed. We've got no credit stress, strong investment in the form of buybacks and mergers and acquisitions and dividends growing. And we've got great earnings growth. We've been talking about this for a while. None of this has changed. If economic conditions were to weaken, now we might get a pullback. So maybe we get a garden variety correction of, say, 10% in the next 3 or 4 months. But the bigger worry is what would induce a bear market, a decline of 20% or more. Now, most strategists are not going to insist that their clients sell on a garden variety 10% correction. But a bear market, if people thought we were heading down more than 20%, you'd be seeing calls to sell out there. So this is all very well studied. What kills a bull market and what induces a bear market? The two killers of bull markets are, one, recession, and two, the Fed suddenly raising interest rates in an unexpected speed. For example, if it were to suddenly raise the Fed funds target well above the 2-year yield. But none of this is happening right now. The market turns down well before a recession begins, and none of the internals of the market are really showing up here. The advanced decline line is at a new high. Buying interest is strong. Selling pressure is still weak. Guys, right now, I don't see any indications that the market is particularly worried about this. China getting a little bit better, though. We've seen the dollar weaken, and maybe we'll see the Chinese stock market finally start to lift its head this year. That moves the market.
Association of Realtors existing home sales in July down 0.7% to a seasonally adjusted annualized rate of 5.34 million units. That's a miss. The street was looking for a slight gain to 5.41, and that is the fourth straight month of declines. We haven't seen that in 5 years, since the summer of 2013 and the taper tantrum when mortgage rates shot up. Sales now down 1.5% year over year and in the low end of a very tight range of sales we've seen this year. What's the problem? Realtors say inventory unchanged in July year over year at 1.92 million units for sale. That's 4.3 month supply. Note, June's inventory numbers were revised lower. It had shown the first gain in several years, but they revised it lower, saying June inventory was actually down year over year. So this is the first month that we're seeing no change, no decline in inventory. Tight inventory pushes prices up 4.5% year over year. Median price of an existing home sale in July was $269,600. The realtors do note, though, price gains are decelerating. Sales on the low end are very, very low, dropping. Sales on the higher end are gaining. Here's the interesting note in this report. Sales of $1 million plus homes up dramatically to 3.7% of all sales. Last year, they were just 2.7%. So again, a drop of 0.7% in July. Home sales very weak. Back to you guys.